Unemployment has increased. In the first quarter, the official jobless rate rose 32.9%. That's from an over one-year low of 31.9% in the previous three-month period. This means that 237,000 more people were without work between January and March. Meanwhile, the expanded definition of unemployment, which includes discouraged work seekers, rose to just over 43% from 41.9% in the fourth quarter. Exxaro is growing its portfolio. The miner has agreed to buy manganese assets in a deal worth 11.6 billion rand. The move comes as it seeks to diversify into energy transitioning metals and renewable energy. CEO Ben Magara says the acquisition, which gives it exposure to 4 operating mines, provides Exxaro with a strong entry point into manganese. The assets are located within the Kalahari manganese field in the Northern Cape, which hosts the world's largest known land-based manganese deposit. Grindrod's exiting its marine fuel trading business Coquette, which it jointly owns with Vital. The firms say they've made the decision to wind down the operations because it's non-core to both shareholders. Coquette is in a sound financial position and will continue to perform all of its existing contractual obligations, but it will not enter into any new business. Bytes Technology has reported higher full-year earnings. That's thanks to sustained demand for its software solutions and services. In the year to end February, headline earnings per share rose 16.5%. In light of the strong performance, a final ordinary dividend of 6.9 pence has been declared. That takes the full-year payout to 10 pence, which is 15% higher than the previous period's dividend. The company has also declared a special dividend, which will result in shareholders receiving an additional 10 pence per share. Bytes is optimistic about its prospects. It says it is well positioned to respond to the evolving demands in its market, which include cloud computing, cybersecurity, and AI. And so the firm believes it can deliver another year of double-digit gross profit growth and high single-digit operating profit growth in its next financial year. Octodec has posted largely flat distributable income after tax at the halfway mark. The real estate investment trust says while interest rate cuts during the period were well received, the benefits of this are not yet visible in its performance. Instead, it continued to battle through a tough trading environment characterized by a weak economy and persistently poor municipal service delivery. Nevertheless, the group has upped its interim dividend by 3.3% to 62 cents. Looking ahead for the full year, Octodec expects growth in distributable income per share to be between 2 and 4%, while maintaining a minimum dividend payout ratio of 75% of distributable income. Altron expects its full-year earnings from continuing operations to be as much as 75% higher. The technology group says continuing operations exclude Altron Nexus. Total HEPS are expected to be between 131 and 136 cents, compared with a restated loss of 29 cents a year ago. That's as the previous period was affected by provisions and impairments. The company will release its annual results on May the 26th. In international news, Japanese tech giant SoftBank Group has announced its first annual profit in 4 years, a significant turnaround that will likely reassure investors reeling from past high-profile setbacks. Let's take a look for more detail.
Japan's SoftBank Group reported its first annual profit in 4 years on Tuesday. It will likely bring relief to investors hit by previous high-profile failures. And as the tech investor embarks on another series of mammoth investments. The Tokyo-based conglomerate reported $7.78 billion in profit for the year ending March, compared to a loss a year earlier. The turnaround illustrates the risk and reward of SoftBank's approach of investing in high-growth technology companies. It's seen success on its investment in Chinese e-commerce leader Alibaba Group, but also the bankruptcy of US office space startup WeWork. SoftBank's holdings in T-Mobile US and Deutsche Telekom have been a consistent source of investment gain in recent quarters. T-Mobile shares hit an all-time high in March and ended the quarter up more than 20%. SoftBank is in the midst of one of its most extensive spending sprees since the launch of its vision funds in 2017 and 2019. This time, it's targeting the companies it deems to be leading the development of artificial intelligence. The scale of the commitments, though, has prompted analysts and investors to question SoftBank's ability to weather market volatility, particularly brought on by new US tariffs.
And Nissan has announced a comprehensive cost-cutting plan, saying it would eliminate 11,000 more jobs and slim down production, capping a tumultuous year that has left the Japanese automaker fighting to turn itself around. Here's more detail in this report.
Nissan unveiled sweeping new cost cuts on Tuesday. The Japanese automaker confirmed it would cut 11,000 more jobs and slim down production. Nissan also saw its profit almost wiped out in the year that just ended. Operating profit hit $472 million in the 12 months to March, a decline of 88% from the previous year. The automaker also held off on releasing estimates for the financial year just starting. The results come at the end of a difficult year as the company fights to turn itself around. Nissan has been hurt by weakening sales in the US and China. It also saw merger talks with Honda collapse and was recently forced to replace its chief executive. New CEO Ivan Espinosa said Tuesday the company would look to focus on profitability and rely less on volume.
We have a mountain to climb from the losses we are announcing today. As our path forward, the Re-Nissan recovery plan is an action-based, grounded in reality and driven plan by determined actions.
The new job cuts will bring Nissan's total workforce reduction to around 20,000 jobs. It previously announced plans to cut 9,000 positions. Rival Honda did reveal its forecast for the current financial year, but it wasn't a glowing look ahead. It projected a 59% fall in profit due to uncertainty over US President Donald Trump's tariffs. It also put a plan on hold to build an electric vehicle supply chain in Canada. Honda's forecast is the latest sign of the challenges car makers face with US tariffs on foreign-made automobiles, all while the industry sees the rise of Chinese EV producers.